Welcome to Get Rich Education. I'm your host, Keith Weinhold. It's Rich Dad Month here on the show. If you're a W-2 job working employee, well, I'm sorry about that, but learn about how to reduce your tax liability, including through gaining the coveted real estate professional designation. Then learn more about how the new bonus depreciation rules can knock your tax liability down close to zero with Rich Dad advisor Tom Wheelwright today on Get Rich Education.
Learn the easiest way to create wealth and passive income with real estate. Now you can access the best deals without the stress or hassle of having to find, renovate, or manage those investment properties. Norada Real Estate saves you time by providing you with passive income investment properties in some of the best U.S. markets. Learn more at passiverealestateinvesting.com and download your free copy of the ultimate guide to passive real estate investing. There's no obligation and nothing to buy. Simply visit passiverealestateinvesting.com.
For a real estate investor like you seeking an income property loan, go to Ridge Lending Group, NMLS 42056. Over the years, you've heard President Chaley Ridge generously devote her time to you here on the show as a guest. Ridge provides investment property loans in most U.S. states, and you're going to find out how they've helped more people realize their dreams of real estate financial freedom than any other mortgage lender in the entire nation when you get started at ridgelendinggroup.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Toledo, Spain to Toledo, Ohio, and across 188 nations worldwide. I'm Keith Weinhold. You're listening to Get Rich Education, and it's Rich Dad Month here on the show, where Rich Dad Advisor and I help you build your wealth each week until finally, on the last week of this month, Rich Dad Poor Dad author Robert Kiyosaki and I talk to you about the importance of investing in real assets. Yes, March is Rich Dad Month. Today, we're talking with Rich Dad Tax Advisor Tom Wheelwright. As I'm sure you know by now, Tom has the uncanny ability to not just have an astounding mastery of how you can pummel your tax obligation down to as close to zero as legally possible, but he also brings energy and life to an area of investing, taxes, which bores most people. Now, how long is the tax code? Well, it depends on how you count it, and there actually are a lot of different estimates out there, but by one estimate, the U.S. tax code is between 5,000 and 6,000 pages. Some estimates are 10 times that, depending on how you count it. Well, Tom has read every word of the tax code at least once. And by the way, that's something that I am just never going to do in this one life that I have to live. But see, the tax code energizes Tom. And since I don't want to do it, I have someone like Tom on my team. Importantly, he knows how to distill down what is important to you. And I would rather focus on what I'm good at. Maybe you would too. That's why I completely outsource the acts of property management, asset protection issues, and tax strategy all to someone else. But I don't completely outsource the knowledge part of these things, only partially, because it helps to know a few of these basics as an investor. Now, one complex area of the entire tax law is real estate. And when you go look for an accountant, a CPA out there that's going to do a tax strategy for you and prepare your taxes, yes, and your tax advisor and tax preparer should be the same person. Well, here's what CPAs out there like to say. They nearly all say, oh yeah, I can do real estate. Well, yeah, maybe they can do it in a halfway fashion, but should they? Look, when it comes to a lawyer, an immigration lawyer is not the same lawyer that you would hire to do your estate planning, and an immigration lawyer should not say that, oh, well, they can do estate planning. And you should probably run away if an immigration lawyer says that they can do your estate planning. Well, just the same, tax law is complex too, and not every accountant is going to deliver you the overall tax burden reduction that you are actually entitled to by law. And that is crucially true for someone like you that invests in real estate and other real assets. We are only a year and 2 months into President Trump's Tax Cuts and Jobs Act of 2017. Well, that act only begins to affect your 2018 taxes. And though we're here in 2019, in a lot of cases, it's not too late for you to still make changes to your 2018 taxes. Now, Trump's new tax law is the most sweeping tax overhaul that the United States has had since 1986. And so many of those 1986 tax changes were, in fact, detrimental to real estate investors. Well, this new tax law is largely advantageous to real estate investors, so this is a big deal. One area of the new tax law significantly expanded is bonus depreciation for income property. Tom and I are going to talk about that today. We also discussed it more than a year ago, right about the time that the new tax law became effective. But a lot of people still aren't taking advantage of this bonus depreciation benefit that you get, and it's still fairly new. But first, I want to ask Tom about a designation that predates the new tax law, and that is how you can still gain the coveted real estate professional tax designation, which really helps you tamp down on your taxes. Now, I would not consider either asset protection or taxes as my strong suits as an investor. That's why I've had asset protection attorney Garrett Sutton here on the show with us 3 times. And Tom is about to be here with us for his record 11th time over the years. So I'm often learning along with you when I have Garrett or Tom here. Taxes are just complex, and trying to go it alone and prepare my own taxes would probably mean that I would miss out on a lot of benefits, and the same could very well be true for you. Let's welcome back a longtime friend of the show here, Tom Wheelwright. You probably already know who today's guest is because he's a regular contributor on taxes here at Get Rich Education. He is the founder of Wealthability. He's the author of the best-selling book, Tax-Free Wealth. He recently authored the book, More Important Than Money, along with Robert Kiyosaki and the Rich Dad Advisors. Welcome back to Get Rich Education, Rich Dad Advisor, Tom Wheelwright.
Hey, it's great to be here, Keith. Always good to be on the show.
We've talked often here about how to reduce your tax burden on your real estate profits, both your cash flow and your capital gains, but not as much about how one reduces their income from their day job. And so I got this listener question. I'm sorry I didn't write down the listener's name, but it's a common one that a lot of people have. And he writes, I'm learning more and more that being a W-2 employee is killing me on taxes. How can I decrease my taxes as a W-2 employee? As I understand it, the losses of rental real estate cannot be deducted from your W-2 taxes unless you are a real estate professional, and I'm not at that point yet. So that was his question, Tom. So I think said another way, what offsets the tax liability on one's ordinary income?
The tax law is very much favorable to professional investors and business owners, and very unfavorable to W-2 employees. And it just is. The key is that you really want to do something about your taxes. You need to be one of those other two. So you can still be a W-2 employee, but become a professional investor. I mean, for example, now here's one that anybody can do. You can invest in oil and gas. Oil and gas is, the government has said, we don't care if you're a W-2, you're a doctor, it doesn't matter. We're not going to consider that passive, even though you have nothing to do with drilling the well. So that is actually one specific investment. Another one would be solar. So solar, alternative energy, those are things that are available to a regular investor. You don't have to be a professional investor to get those tax benefits. And there are frequently the state tax benefits are even greater than the federal tax benefits.
Those are activities that offset ordinary income even when you're not a real estate professional?
Correct. They have nothing to do with the real estate professional designation because they're not real estate. I mean, they're not really considered real estate. So there are literally thousands of incentives. And I mean, there still are a lot of incentives for the W-2 employee. But if you really want to make that a big dent, then you really need to be more involved in your investing, or you need to set up a business because business owners actually get the best of the tax benefits. I mean, if you think about it, the reason that real estate professional is so important is because all the government's saying is, if you're in the business of real estate, if that's your business, we're going to give you the deduction. If that's not your business and you're just a casual investor, we're not going to give you the deduction.
And Tom, I think we should talk more about the real estate professional in a moment, but maybe just to back up to get a broader understanding of what we're talking about here. I mentioned ordinary income earlier. You brought up passive income. There really are 3 different income types.
There's actually 4. The first one to consider is earned income. So whether you're a business owner or an employee, earned income, because it not only pays tax as ordinary income, but it also pays Social Security taxes. So earned income is the highest tax rate. Second would be ordinary income. Third would be capital gains, which includes most dividends from U.S. corporations. And then the fourth would be passive. And passive means that you're invested in a business, but you don't spend much time in that business. That's what passive means.
I think with that terminology, that'll better help us understand the real estate professional designation, why that's desirable, and what that does for you. So we have 4 income types: earned, ordinary, capital gains, and passive. How does one, as they're building up their real estate portfolio, how do they get that very desirable real estate professional designation sooner? That's what I want to know, because when I was an investor coming up, I was probably up to 30 units, 40 units. And I remember I tried to make myself a real estate professional, and my tax preparer said, no, you're not a real estate professional. And a lot of it was my problem was that others were managing the property for me, and I didn't have that involvement.
Right. So it's a bright line test. So I'll tell you what the bright line test is, but then I'm going to give you all the workarounds to it. The bright line test is you have to spend more than 750 hours actively in real estate, and you have to spend more time in real estate than all your other business activities combined, including your W-2 job. If you have a full-time W-2 job, while it's possible to be a real estate professional, there's actually a court case where a nurse was able to prove that she worked more hours in real estate than she did as a nurse, and she worked like 2,400 hours in nursing. So consider that one. You do have to have more than your other job. So it is very tough for somebody who's got a full-time job to be a real estate professional. If you're married and one of you is a stay-at-home parent, then it only has to be one of the couple. As long as you're filing a joint return, it only has to be one of you. So you don't have to both be, or the real estate can be in your name and your spouse can be the real estate professional. That's all fine and good, because the law looks at a joint return as a single taxpayer. So that's one workaround, is that this person who sent this in may not be married. And if you're not, well, that would be one of the benefits of getting married. There are a lot of downsides tax-wise to being married, but that is one of the upsides to being married, is if your spouse can be a real estate professional. The other thing is remember, it's not that passive losses aren't deductible. It's that passive losses are only deductible against passive income. So what that means is that, let's say that you own a business. Now, if you're a W-2, you're going to have a tough time with this one. And you're very actively involved in that business, but your kids aren't. Well, if your kids owned the real estate and your kids owned the business, then there would be passive income and passive loss. So that would be a case of matching up passive loss with passive income. People are always looking at, how do I make this non-passive, this loss non-passive? That's only half the equation. The other half of the equation is, how do I make my income passive? In many cases, that's the most important part of the equation. If you're a single individual and you have a full-time job, you're going to have a tough time being a real estate professional. You're going to have a tough time taking your real estate losses. Now, it's only temporary. So passive losses free up entirely when the property is sold. You sell the property, you may have capital gain, but you may have these passive losses that are ordinary losses, and they offset your ordinary income. Actually, in today's environment, with the new bonus depreciation, which I'm sure we'll talk about at some point, I've seen a lot of situations where people are better off tax-wise not doing a like-kind exchange on their real estate. Because if you do a like-kind exchange, those passive losses carry over to the new property. Whereas if you sell it outright and don't do a like-kind exchange, even if you invested in another property, those losses all free up when you sell it in a taxable sale. On top of that, when you buy the new property, now you have bonus depreciation and you have a whole new set of depreciation for that new property. We get a lot of historical kind of memory. And when a tax law like this changes, we ought to throw that memory out and start over again.
I just learned something there about one of the downsides of a 1031 tax-deferred exchange, and I think that there are plenty of upsides. And yeah, I did not get the real estate professional designation until I quit my day job. And just to reiterate, Tom let us know that the real estate professional designation is something that can be qualified for when you are actively involved in your real estate investments for at least 750 hours a year, and it's your primary activity.
Right, it has to be your primary activity. Now, there's one other exception. If your income is under $100,000, then just having a little bit of activity in the real estate, you can't do this with a limited partnership interest. You can't be a limited partner. But if you go out and if you were to buy single family homes or you were actually doing your own investing, you would qualify as what the IRS calls an active investor, which means that the first $25,000 of losses are not passive. And that's a really easy test to meet. You just have to get your income down below that $100,000 mark. And it's $150,000, but there's a phase out between 100 and 150. If you can get your income down, for example, you might get your income down by increasing your 401k contribution. As much as I hate 401ks, you might be able to get your income down by maxing out your 401k contribution, right? You might be able to get your income down by having a home business so that you've got those losses to offset. So there are ways to get your income down below that threshold. And if you do that, then you free up to $25,000 of those losses.
Yes, the tax code can often be complicated. Oftentimes when incentives are introduced, that's great, but it also complicates the tax code as well. I guess that's why people rely on you. This gives you a job, Tom.
This last tax act, the Accountants Full Employment Act.
Yeah, that's right. The Tax Cuts and Job Act, the Accountants Full Employment Act. Yeah, they're pretty much the same thing. And just as a reminder, if you didn't catch it from Tom there, you don't need to get a real estate license. You don't need to be a licensee, a realtor selling property in order to get your real estate professional designation. Just so everyone has a clear understanding of why this designation is so preferable, just tell us more about the advantages of having that sought after real estate professional designation, because I think a lot of beginning investors, once they learn about it, they aspire to be that.
Right. Well, I think it does two things for you. The obvious one is the tax consequence, which means that those losses from your rental real estate are no longer passive. They can offset any kind of income. They can offset capital gains. They can offset ordinary income. They can offset any of your other taxable incomes.
Now, what's the example of a passive loss?
So a passive loss is a loss from a business that you're invested in that is not a corporation. So, for example, if you're invested in, let's say you were an angel investor in a small company. Somebody had an S corporation that's a flow-through entity, and they needed to raise, $50,000, and you invested the $50,000. Well, your income from that, which flows through on your K-1 from that S corporation, would be passive. The same is true for real estate. Rental real estate is what we call per se passive. That's a Latin term, and that's used in the legal business, which means that it is by definition passive. So regardless of how much time you spend, the general rule is it's passive because it's real estate rental. However, there's this real estate professional rule that says if you meet these tests as a real estate professional, now it's no longer considered passive. By the way, there's another test here. So for real estate professional, it's 750 hours. But every activity, every business activity or rental activity, you have to meet the regular rules for not being passive. And the regular rules generally are 500 hours per activity. That means if you had 50 single-family homes, you would have 50 activities, and it's pretty unlikely you're going to spend more than 500 hours in each activity. So there is an election that you can make, and everybody make sure you make this election that if you're going to be a real estate professional, it's an election to aggregate or combine all of your real estate activities and treat them as a single activity. That way, by definition, if you had 750 hours, then you're going to have 500 hours, right? Because 750 hours is more. Let's say, for example, that you own a construction business. Well, if you own a construction business, you're a real estate professional. But you may have 2 rental properties. You could still be passive in those rental properties because you still have to meet the rules for not being passive. It's just that the real estate professional means you're no longer per se passive or by definition passive. And I know this is a lot, but I presume people can listen to your podcast over and over again. Right, Keith?
That's right. They sure can. So we're talking about the highly sought after real estate professional designation. 750 hours a year distills down to about 15 hours a week. And that's got to be your primary activity. Let's come back and talk about bonus depreciation with Rich Dad Tax Advisor Tom Wheelwright. This is Get Rich Education. I'm Keith Weinhold. MC Lobsher is the host of the Cashflow Ninja podcast and president of Producers Wealth. He is on a mission to help you achieve financial independence and freedom as soon as possible. He achieves this by integrating the infinite banking concept with real estate investments to increase your returns and recapture cash flow that you are not even aware of that you're losing. MC shares the number one strategy of investors in his holistic wealth creation course at yourownbankingsystem.com. Finally, Total Control Financial gives you checkbook control of your 401k and IRA money to invest in real estate. It's time to get your retirement money into your own checking account, but you've got to avoid the little-known tax that you'll pay with any self-directed IRA. Instead, it's time for the QRP. Learn more and get your free copy of the QRP book by text messaging QRP in all capital letters to 72,000.
This is Peak Prosperity's Chris Martinson. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education. We're talking with our most frequent guest ever, Rich Dad Tax Advisor Tom Wheelwright. Tom, the Tax Cuts and Jobs Act of 2017 under President Trump really dramatically changed a lot of the rules for taxation across the country and for real estate investors. And perhaps one of the most beneficial bones that real estate investors were thrown were the bonus depreciation rules. Tell us about that.
Oh my heavens, that's like manna from heaven.
Yeah.
Okay? Because here's what happens. Consider that the biggest tax benefit of real estate is depreciation, right? And depreciation is simply being able to write off your investment over a period of years because things wear out, okay? Even buildings wear out. So when you buy a property, technically you're really buying four groups of items. You're buying the land, which doesn't wear out, so you don't get to depreciate that. You're buying the building, which wears out over a very long period of time, so you get a deduction over a very long period of time. Residential is 27 and a half years, and commercial is 39 years. The challenge that most people have is their accountants tend to stop there.
Right.
But they don't consider that there are two other aspects of what you're buying. I'm looking out my window here, my office window in Tempe, Arizona, and I see a building across the street, and it has trees, and it has sidewalks, and it has lighting, and it has a lawn, and it has all sorts of landscaping, and it has covered parking. And guess what? Those are all land improvements. And while the building itself is depreciated over 39 years, in this case, it's a commercial building, the land improvements are normally depreciated over 15 years. So that by itself is a huge benefit. As long as you break it out, that's called a cost segregation. And then inside the building, you have lighting, you have cabinetry, you have flooring, you have ceiling fans, you have window coverings, you have all sorts of things. Those are the contents of the building. Those are depreciated over 5 to 7 years historically. Again, you have to break that out, have an engineer come in, do the work, and make sure that you can properly allocate the cost of the purchase price between those items. And that's called a cost segregation. And it does require a professional to do it. And it's something that should be done on every building, frankly. If it's an investment building, whether it's commercial or residential, large or small, you should do a cost segregation just for, and we've been talking about this for years, just so you can get that faster depreciation. Because what we want is we want our money now. We want our tax benefit now. Okay, so under the Tax Cuts and Jobs Act, what we have is we have bonus depreciation, which applies for the first time to used property. So most real estate is used. It's not brand new construction. And so bonus depreciation historically is not applied at all, okay, to most real estate ventures. So what we have is we have this bonus depreciation that applies even though it's used property. Bonus depreciation is, instead of deducting it over a period of time, you get to deduct the cost immediately, the day you place it in service. So looking at this building across the street, all of that landscaping, all of the covered parking, all of the lighting, all of the contents of the building, anything that has what's called a class life, which means it's going to be depreciated over less than 20 years, can be deducted immediately. My experience, you tell me if you've got a different experience, Keith, but my experience is most commercial and residential rental property, if you do a cost segregation, you're going to come up with somewhere between 20 and 30% of the purchase price being allocated to land improvements and contents. Well, consider, let's make it really simple. You put $20,000 down on a $100,000 single family home.
Yeah.
You could have depreciation the first year of up to $30,000, even though you only put down $20,000. So you actually get a deduction for more than your investment. The bank doesn't get the deduction, you get it.
Yeah, that's another form of leverage. But is there any sort of cap or limit to you taking a $30,000 deduction from just this one property in year one?
Again, only that could be passive. So going back to our passive discussion, if you're a real estate professional, no cap. And in fact, let's say that your depreciation is so big that it offsets all of your income and creates a loss. You can carry that loss forward to future years.
That's astounding.
A really big deal. Just the other day, talking to a new client, and we're helping them reduce their taxes. And normally in a first call, I can come up, first time I talk to a business owner, I can come up with, somewhere between $10,000 and $50,000 of tax savings. I'm talking to these folks, and it turns out that one of the spouses is going to qualify as a real estate professional, and they actually bought enough property in 2018 that the bonus depreciation will offset 100% of their ordinary income. They will go from paying taxes of upwards of $400,000 or $500,000 to taxes of zero in a single year.
That's the power of bonus depreciation.
It is. Now, remember, it actually creates an addiction, because what happens is now you don't have depreciation the next year, right? All you have is your building, which is like 3%. So what do you have to do? You need to buy more real estate next year. So you have to buy more real estate every year. Well, what does that mean? That you're going to continue to build your cash flow. You're going to continue to build your wealth. And the more real estate you buy, the less taxes you'll pay.
This is only for new purchases or existing purchases in one's portfolio?
So a cost segregation applies to even existing purchases. If you bought it prior to September 27th of 2017, then you're under the old depreciation rules, but you still get the 5, 7, 15-year depreciation instead of the 27.5 or 39-year depreciation. Right. So it's still worthwhile to do the cost segregation, even if it's property that you've owned 4, 5, 6 years. But for anything you've purchased since then, you get the bonus depreciation.
Sure, the cost segregation rules have been around for a while. Well, Tom is just a whirlwind in the way that he can go ahead and help eliminate your taxes and make you aware of things that you didn't even know about before. Tom, if someone wants to connect with you, learn more about you, where should they go?
Really simple. Go to wealthability.com. Just go to wealthability.com. And there's a click to schedule a call, and we're happy to talk to you and see if there's some way we can help you. Even if it means finding you a CPA, we can help you find a CPA.
Tom helped me find my CPA that I still use to this day. Tom, it's been so great having you here. Thanks for coming back onto the show.
Thanks for having me, Keith.
More vital information from Tom today here to kick off Rich Dad Month. Consider this. The U.S. government is spending $12.4 billion with a B dollars a day. If our government somehow turned this around and began running a $1 billion profit per day, in other words, if tax revenues exceeded outlays somehow, and then used that daily surplus to pay down our $22 trillion debt, the nation still wouldn't be debt-free for 60 years and 4 months, or by July of the year 2079. And those numbers are from our own Treasury Department. It's just an astounding revenue shortfall that the United States has. So over the long term, my point is that the nation needs to raise revenue. One way to do that is with higher taxes. So involve yourself with the right tax professional. That relationship is going to benefit you for the long term. And when you're a real estate investor, you have the potential to use what's probably the greatest tool for reducing the biggest expense in your life. And that tool is your direct ownership of real estate. Next week, we have installment 2 out of 4 here in Rich Dad Month as Rich Dad Real Estate Advisor Ken McElroy and I are going to tell you how to optimize building your wealth with real estate investing. Thanks to the talented Tom Wheelwright today, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Countless investors get killed on their long-term maintenance costs in their rental property portfolio, but that's far less likely when you buy brand new construction. Let me tell you about my friends at JWB Real Estate Capital in Jacksonville, Florida. They pioneered the build-to-rent model that allows clients like you to invest in new construction, turnkey rental property. That's why JWB has been featured on the front page of the Wall Street Journal and other national media. If you want new construction rental properties in your portfolio, talk to JWB. Give them a call at 904-677-6777 or visit them at newconstructionturnkey.com. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.